Hello fellow investors, and this is InvesTips, and welcome back to another video. In this video, we'll be discussing dividends. Firstly, we'll talk about what dividends are, then we'll talk about the benefits of investing in dividends, before finally going over some tips and explaining how to invest in dividends safely to ensure that your portfolio grows. So, what are dividends? A dividend is a payment that is given to investors for investing in a company. These are given out over a fixed interval of time and can be received either yearly, quarterly, or on a monthly basis. Many different types of investments can pay dividends, but in this video, we'll be focusing on stocks. The payments are in the form of a dividend yield, which is expressed as a percentage between the ratio of the price of a dividend over the price of a stock. This shows how much a company pays out in dividends each year relative to its stock price. So a higher yield represents a higher dividend payout for the amount of money that you invest in it. However, as we'll see later, dividend yield is not the only thing we should consider when evaluating a dividend stock. Dividend investing is a strategy that gives the investor two streams of income at once. First of all, you have the appreciation in the value of the asset, such as a stock, so as it goes up over time, you'll get money just like any other stock, but you'll also have the dividend payments over a period of time. So every interval of time, you will receive payments from the company in addition to what you get from the stock. If careful, this can be an excellent investing strategy that can accumulate a lot of wealth over long periods of time. But there are some risks that you should consider, which we'll go over in detail in this video. Let's take a look at an example. Let's say, for instance, that I invest in a stock with a price of $100, and let's just say I decide to purchase 100 shares of the stock, giving a total cost of $10,000 in my investment. The stock that I invest in has a dividend yield of 4% annually, which is a pretty decent yield. Every year, then, I would get 4% times $100 multiplied by the 100 shares that I hold, which would be $400 in dividends that I would get directly from this investment. And this is in addition to the price appreciation of the stock. I can then reinvest the $400 back into the stock, or I can invest it in other stocks or just spend it. So you can see that for every $10,000 that I invest in, I'll get $400 every year. This is a great way to make easy money and passively generate income without having to make any additional investments. So why invest in dividend stocks? There are three primary advantages of investing in dividend stocks. Firstly, they're reliable. This is fairly intuitive because every month or every year, you'll be getting money from these dividend stocks, no matter their price. So you'll always have a steady stream of income flowing into your portfolio. It's a very reliable source of income. Make sure to choose companies that are reputable and have been known to always pay back their dividends to ensure that your money won't get lost. Secondly, dividend stocks are long-term. Dividend stocks are far more stable than other stocks. They're quite resistant to volatility in the markets. Also, due to their strong long-term outlooks, new investors are always eager to invest in them, so their stock price almost always increases in the long term. The third benefit to dividend investing is risk reduction, because in addition to the fact that dividend stocks can weather short-term volatility, their dividend payouts also mitigate any risk of a decline in stock price, because even if the stock price goes down, the money lost can still be regained through the monthly dividend payouts. Historically, dividend stocks have also outperformed other stocks in bear markets and during recessions, so they are always a good hedge to consider during bear markets. So now that we know what dividend stocks are and what their benefits are, there are still a few things that we need to keep in mind when dividend investing. Here are 5 tips to keep in mind when you invest in dividends. Number 1, evaluate the company. You should always look at the features of a company when you decide which company to invest in. So look at things such as the financial ratios, their competitiveness, any recent news or financial statements that they've released. We have already made a video on choosing good companies to invest in. Make sure you check that out for a detailed explanation. In general though, just choose companies that you think will grow in the future and that other people would be willing to invest in. Number 2, look at the company's debt. If a company has high debt, there's a very high likelihood that they will cut dividend payouts in the future to help them pay back their debts. Make sure to look for companies that have lower debts compared to their competitors, as this will ensure that their dividend payouts stay stable. Tip number 3 is to be careful of high dividend yields. Very high dividend yields are sometimes dangerous because it shows that the company is desperate for cash and is trying to lure in new investors. As soon as these new investors stop flowing in, the dividend yield is very likely to suddenly drop. It also means that the company isn't investing enough in itself and is instead spending all of its earnings on shareholders. To be clear, high dividends are not always a bad sign, and some very good stocks have high dividends that can earn you a lot of money. Just be careful if it has unusually high dividends that are much greater than other stocks of similar industries. Number 4 is to look at the history of the stock. You should try to look for dividends that have been stable or even increasing for a long period of time. This shows that the company is reputable and has been known to pay back its dividends, so to ensure that your investment will be secure. If a dividend yield has been trending downwards, this means that the company could be struggling financially, and there's a very high chance that the company may cut its dividends again in the future. Therefore, you should try to stay away from these kind of stocks. Also, if the dividend yield was sharply raised quite recently, this could be a sign that the company is trying to lure in new investors and is highly likely to be very unsustainable. Try to stay away from these kinds of companies. The final tip for today is to look at a company's payout ratio. And the payout ratio is simply the percentage of a company's profits that is paid to investors as dividends. So for example, if a company had $1 per share in earnings and then paid 50 cents to investors as dividends, then its payout ratio would be 50%. The lower the payout ratio, the more sustainable the dividend yield is. A payout ratio that's very high, especially over 100%, indicates that the company isn't earning enough profits to pay its dividends, so it's probably financing it through debt. This indicates that dividend isn't sustainable, so it's quite likely going to be lowered in the future. So, to summarize, here are the 5 key things to look for in a great dividend stock. First of all, having a good company. A good company is likely to grow in the future and increase its dividend yield, as well as an appreciation in its stock price. Secondly, look at its debt. A good dividend company has low debt compared to its peers. Thirdly, look at the history of the dividend yield. Look for a dividend yield that is steadily growing or has been stable for a long period of time, and make sure there is a lack of dividend cuts recently. Fourthly, evaluate the dividend yield. Make sure that it isn't too high as to be unsustainable. And finally, look at the payout ratios. Make sure that it is under 100% at least, and make sure that it is as low as possible so that the dividend yield will stay stable into the future. A bonus is to look for recent earnings growth, because if a company has higher than expected earnings, this could be a signal that it can pay out additional amounts of money to its investors as dividends. That is it for today, guys. Hopefully you learned a bit more about dividends. Please consider liking this video and subscribing and sharing it with your friends. It would really mean a lot for us at InvesTips.